I'm Oliver Sloup with Blue Line Futures, coming to you from the Chicago Board of Trade with another episode of Tech Talk. It is Tuesday, April 26th. We've got three markets for you today: corn, live cattle. I'm going to wrap things up with the lean hog market. If you recall, last week was option expiration for the May grain options. So with that behind us, a lot of the attention shifts towards the July contract. So we've got July corn pulled up here, as you can see. Choppy trade here today. This comes on the back of yesterday's pretty nice reversal after defending Friday's lows. That was a pretty significant support pocket. This basically was the retracement of the breakout point from April 18th and what we would kind of refer to as a must-hold area. A break and close below there would open the door for a potential retest of this April 5th rally, or where we started the April 5th rally, closer towards 740. So the bulls got saved by the hair on their chin there, and they're looking pretty good. We're on the verge of making new highs out above 810 to 814. Breakout above there puts us back in uncharted territory. We continue to be a little bit skeptical here on these front month contracts. We've been pretty outspoken about how we feel about the deferred contracts looking at December 22. If you're wanting to play a weather market, I think that's where you're going to want to be. Obviously, yesterday's crop progress report came out a little bit slower than expectations, but I don't think it was anything to get up in arms about just yet. We've learned year after year after year that American farmers, producers, are pretty darn good at what they do, and they get the crop in the ground at the end of the day. Obviously, when they get it in the ground does make a bit of a difference, but they will get it in the ground eventually. It's not a matter of if, it's just a matter of when. But back to the technicals, July corn. The chart looks constructive. We remain a little bit hesitant at getting overly optimistic in the near term. Deferred contracts remain strong, even all the way out to D's 24. Take a look at those, D's 23, D's 24 corn. And moving over to the livestock side of things, we've got August live cattle, which has sold off very heavily to start the week. A lot of headwinds in that market. We had Friday's bearish cattle on feed report, which was a damper, and then we had news that there were potentially Chinese lockdowns expanding, and then also just concerns over recession here in the United States as the stock market continues to slide lower and lower and lower. So a lot of hurdles for the cattle market to overcome here this week, and I think it will overcome a lot of those hurdles, but it might take some time here to work out through those. This is the August contract that we've got pulled up here. As you can see, we're basically right smack dab in the middle of the range that we've been in since the beginning of the year. So not a whole lot to do if you don't have a position on. We've been leaning on the short side with clients, and in our daily commentary that we send out, looking for a potential retest towards this 134 area. And at that point, I think that's where the risk reward favors the buy side. A break and close below the low end of this risk range, you take your medicine and move on, but we're kind of waiting to see if we can't test this down here. Now, where we're wrong is a breakout above. That's up at 142. Now, there is a gap here that's going to be probably partially closed, if not all closed at some point. I don't know if that's going to be this week or another couple months down the road, but this is going to be a gap to keep a very close eye on going forward. Now, wrapping things up with the lean hog market, that has been one that has kind of been a waterfall effect as of late. We failed to get out above the top end of this right shoulder, which is more and more looking like a head and shoulders formation, and now we're threatening to break down below the low end of the range. We've been pretty vocal about buying in the 112s with clients, and we still like that idea so long as this can continue to hold on a closing basis. A break and close below here opens the door for some potential more air to be let out of the market. A little support at 107 and a quarter, but the big line is going to be where we started breaking out of back in the middle of January, and that comes closer towards that psychologically significant $100 level. So all eyes are on this lower end of support here, 110 to 112 area, plus or minus. This is a must-hold area. We like the risk-reward here to the buy side, but need to see something here in the next couple of sessions to feel good about holding that viewpoint going forward. So that's what we're looking at. That's what you should be looking at too. This has been Oliver Sloup with Blue Line Futures, coming to you from the Chicago Board of Trade. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.